Welcome to Creating Wealth with Jason Hartman. During this program, Jason is going to tell you some really exciting things that you probably haven't thought of before and a new slant on investing. Fresh new approaches to America's best investment that will enable you to create more wealth and happiness than you ever thought possible. Jason is a genuine self-made multimillionaire who not only talks the talk, but walks the walk. He's been a successful investor for 20 years and currently owns properties in 11 states and 17 cities. This program will help you follow in Jason's footsteps on the road to financial freedom. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to the Creating Wealth Show. This is Jason Hartman, and this is episode number 212. Thanks so much for joining me today. So we haven't been with you in a little while here. We've been a little slower producing shows. I know that. I apologize for it, but gosh, we are busier than a one-armed paper hanger. It is really, really busy, and I'm just glad to see it. Certainly, prudent investors and the smart money is out there looking to scoop up deals at some of the lowest effective costs in probably a couple of generations, potentially. Boy, I tell you, we've got our Phoenix tour coming up, and we pretty much sold that out. However, I am trying to work out expanding the room block a little bit with the Ritz-Carlton, and we were not able to get a larger tour bus because the big diesel pusher type buses cannot fit through some of the residential neighborhoods where we'll be looking at properties. So we may get a second van or something like that to go along. So you can still sign up. That is my answer, but we're going to be a little tentative about taking more people because we might have to say they're actually kind of on standby for just a few days here until we firm up that room block with the Ritz-Carlton. But if you do register, go ahead and register if you want to at jasonhartman.com, and we'll contact you within just like a day or two if there's a problem. If we don't contact you, you're all set to go, and we're good to go for the Phoenix tour. That's our Phoenix Distressed Property Tour on May 20th through the 22nd, based at the Ritz-Carlton in the Biltmore area, Scottsdale, Phoenix area. And by the way, for those of you attending, several of you have asked about a schedule, and we are starting the event officially, meeting at the Ritz-Carlton Friday evening, May 20th at 7 p.m., where we will walk across the street to the Biltmore area to have dinner, and we'll do that all together. Of course, that dinner is hosted. Put your wallet away. We're treating. It's on us, and I think it's just going to be a great weekend. And then the following morning, we'll reconvene in the banquet room at the Ritz-Carlton. We'll have breakfast there, and then we will do some education, kind of a briefing of what we're going to see, and then we will get on the tour buses and travel the area and have lunch together, and then we'll come back. We'll take a break for about an hour and a half, then we'll reconvene for dinner on Saturday evening, and then we'll have fun there, and then brunch on Sunday morning again, and it's just going to be a fantastic weekend. So thank you for all of you who've signed up. I'm really just pleasantly surprised with the response on that event. Again, we are subsidizing the event a little bit, so there won't be any specials or discounts or promos on that event because we are actually technically losing money on everybody who attends, but we think we'll definitely make it up because the investments are so compelling there that we know you're going to be purchasing properties that weekend. And if you do purchase that weekend, by the way, we refund your cost of your trip. That makes it even more and more appealing. Hey, speaking of properties, before we get into today's show here, just want to run down the list. If you were to look at jasonhartman.com and click on the available properties area, I want to talk to you about one property here in the Atlanta metro area. This one is in Ellenwood, and wow, what an impressive property. I mean, if you were to see the photograph of this, if you go to the website and look at the photo of this property, you will be blown away. I mean, it really makes someone who lives in an area like California or Portland or Seattle, or when I say California, I know that's not a city, I understand that, but virtually everything in California is expensive, so that's why I refer to it that way. If you live in the Northeast or any of these expensive areas, it is just mind-boggling in the greater Atlanta, Georgia area, in a really nice community like Ellenwood, what you can get for the money. Check this property out. This is almost 1,900 square feet. It's $86,000, $85,900, built in 2001, so it's only 9-10 years old. Your positive cash flow from the get-go is projected at $198 per month, almost $2,400 per year. Your return on investment is projected at 31% ROI with some very conservative assumptions. And you can get in this property, all told, with your closing costs and everything, a turnkey ready-to-rent property for less than $19,000. And you're only paying $46 per square foot for a property that is this new. And if you saw the photo of this house, it is gorgeous. It's an absolutely beautiful, gorgeous property. So again, the deals are mind-boggling that are out there today. In Phoenix, since we were talking about Phoenix, and we're going to go to our market forecast here. That's what today's show is about, so we'll be at that in just a moment here. But in Phoenix, let me just look at the list here. And for our distressed property tour coming up in May 20th through the 22nd, we are trying to get we're going to have a minimum of 8 really good mix of properties. And then we may have about 15, 16 properties to see. And again, properties are going very quickly there. It's very hard to source good properties because our group is so picky with what we bring you. If we wanted to bring you a bunch of junk like all of these other groups have, older properties in really marginal neighborhoods, it would be a lot easier. But we depend on repeat customers. We depend on volume through repeat business and referrals and recommendations. And we know the way we're going to earn that confidence is to bring you really good quality properties and, of course, good quality advice and strategy and education. So a couple of Phoenix properties, let me just give you an example. You can see these for yourself on jasonhartman.com. But I will tell you that many of the properties that we will see on the tour coming up May 20th will not be on the website until after the tour, and many will actually sell that weekend, so they will never appear on the website. But what's on the website now, Phoenix, $75,000, projected cash flow $289 per month, and projected ROI, return on investment, and this is before you consider the benefits of inflation, except in the modest appreciation. But you don't consider the what I call inflation-induced debt destruction. You don't consider regression to replacement cost in these numbers that I'm talking about. Our ROI projection without those things is 39% annually. 39% annually. I mean, that's with a property manager doing the work for you, not self-managing the property. This is just a phenomenal time to be considering these properties. Another property, also $75,000, 33% and $290 per month. Another one, $78,000 property, $273 per month and 31% projected ROI. And get this one. This one's the best of the bunch in terms of the sheer numbers. $79,900. A projected cash flow of $331 per month, and an ROI projected at 40%. That's 40% annually, not in your first year. Annualized return on investment. And just think of what happens if things regress to replacement cost. Wow, phenomenal. I mean, just mind-boggling opportunities here. A couple of questions we had before we get to today's topic, which is our forecast for 2011 and beyond, on our Facebook page, and please participate in our Facebook page. Just look up Platinum Properties Investor Network on Facebook. And Daniel writes, I listened to your podcast, Anything for Australia. Well, the answer, Daniel, is no. We have looked at some properties in the greater Melbourne area, and I have been to Australia myself, love it, great place to visit. Sydney Harbour has got to be one of the most beautiful places on earth besides Cape Town, South Africa, and a few other places. But as I've said many times, we have looked extensively at international property opportunities. I've looked at them in many foreign countries, from Eastern Europe to Belize to Panama to Argentina. And real estate in the United States is pretty special. And it's pretty special for several reasons, not the least of which is that since the Great Depression back in the 30s, the government has really subsidized the financing of real estate in the U.S. And that is totally unique to the United States. It does not occur in Australia. It does not occur in other markets. You have really, really special opportunities in terms of arbitraging the declining dollar And that's one reason so many Australians and so many New Zealanders and Canadians and really people from all parts of the world are looking at America as a great place to invest right now. You have the mortgage possibilities, and I know that many international investors don't qualify for mortgage financing, so I completely understand that. But even without mortgage financing, remember, the people that eventually buy the property from you qualify for mortgage financing, and I contend that that's one of the things that makes the American market particularly attractive. And then you look at American governmental irresponsibility and the way we are printing money like it is going out of style in this country, and our dollar is weakening and the future of the dollar looks very negative. So use all of that stuff to your benefit by buying these commodities that are globally traded and buying them with ever depreciating dollars. What does that do? Well, it cancels out any debt you might have on the property either now or in the future, or that debt your future buyer has on the property. It makes rents go up. It makes the value of the commodities go up. And guess what else? The quality of American construction is generally, and this is a big generalization I'm about to say here, but I would say that it's generally better than it is in many other countries when you consider apples to apples comparison of price and kind of low-end construction here I think is better than low-end construction elsewhere. Middle market construction here I think is better than middle market construction elsewhere. Of course, that's a pretty hard thing to really evaluate, but that's just my general sense of it. And I think that's because of the building codes and the regulations in America. And I don't like government regulation. I'm sort of a free market guy, pretty libertarian in my political views, but that works for you in some ways. And it also keeps the supply limited because in the U.S. it is hard to build things, whereas in other countries it may be easier to build things. Now, of course, that depends on by areas and cities and a whole bunch of factors. I'm just making a general statement. And so that works for you. And I think the U.S. is pretty darn unique. I can't beat it. I've been to 64 countries. I've looked all over the world. I've looked for real estate investments. And, I've done shows on that. I've talked about it extensively, and so far I cannot find any market that beats the U.S. The other thing that concerns me when you go overseas is the threat of corruption. And I think in the U.S., I like to jokingly say that our corruption here is legalized, and it's called lobbyists and politicians, and certainly they're corrupt, but at least you kind of know what you're getting. It's not the sort of petty corruption that you have certainly in Eastern Europe and markets like that and Central and South America. So again, I haven't been able to beat American real estate. I've looked in Australia, I've looked in New Zealand. I remember when I was in New Zealand traveling with my girlfriend there, we thought we wanted to just get out of the rat race and go live in Lake Wanaka. What a beautiful place that was, and fairly low prices. It's like paradise. But again, I think as an investment, as a pure investment, nothing really beats the U.S. market. And maybe I will be corrected someday. My recent trip to Belize, I felt the same way. We looked at properties there, not even close to the U.S. market and what it offers. Okay, another question. What is your opinion of the Maui market? So now we're talking about Hawaii. What is your opinion of the Maui market? There are many foreclosure deals that don't make sense for rental yields, but I do believe the near-term appreciation might be worth buying and holding, say on a 1 to 3 year horizon. Example, a house for sale below the assessed land value with a tenant covering the principal and interest on the mortgage, but not the taxes or other expenses, like my trip or vacation to visit the property. So Chase is a client of ours, and he asked this question, and Chase, I really think you're looking for more of a tax-deductible vacation than you are an investment. I have to be honest and say that I have not looked at Maui or Hawaii closely in terms of real estate. I have been to Maui a few times, and that is a gorgeous place, no question about it. Last time I was there for a friend's wedding and had a great time, but again, I don't think the investments really work anywhere in Hawaii that I know of. Now, the next time we come around to a appreciation market, a cyclical market, I might change my tune if you want to do something speculative there, but again, I don't think as a pure conservative investment it makes sense. If it did make sense, we would be talking about it, we'd be recommending it, and we'd have deals with affiliates there that we could make money referring customers to invest in those markets. And the reason we're not doing that is because we haven't found anything that makes sense. But again, have not looked at that market real closely. That is my disclaimer. So let's talk about today's show. Now, today's show is a call that we did for our members several months ago. And again, occasionally we will take members' content like our $20 call that is free to members that we do once a month, and we will broadcast it on the show. And we're going to do that this time because it's several months later than that call was originally done for members. And the reason I want to do this is because we're moving into the year now, and I'm starting to see a lot of my predictions come true in terms of the multidimensional aspect of real estate investment. And as such, I think it is vitally important that any of those of you who haven't purchased our predictions report, that you purchase it. You know, we have specials occasionally on our Frugal Friday deals, and I want to reopen the special that we offered many months ago. And again, when it comes to predictions and forecasts, you want to be in on those early. So ideally, you were on that call, you purchased the report several months ago, but if you didn't, I just wanted to reopen that opportunity to you, and you can use the same promo code, and we will leave it up, say, let's leave it up till about May 22nd, the last day of our Phoenix Distressed Property Tour. So we will leave it up until May 22nd, that promo code that you will hear at the end of this, so you can get a really special discount on the forecast. And our forecast is totally unique because it covers the multidimensional nature of an income property investment. You're also going to hear on this conference call, you're going to hear some really unique stuff about population trends and where we think the overall market is going in terms of packaged commodities investing and so on and so forth. So I don't need to belabor the point. It's covered on the upcoming call you're about to hear. So listen into that, and we will be back with it in less than 60 seconds.
What's great about the shows you'll find on jasonhartman.com is that if you want to learn about investing in and managing income properties for college students, there's a show for that. If you want to learn how to get noticed online and in social media, there's a show for that. If you want to know how to save on life's largest expense, there's a show for that. And if you'd like to know about America's crime of the century, there's even a show for that. Yep, there's a show for just about anything. Only from jasonhartman.com. Or type in Jason Hartman in the iTunes store.
Good evening, everybody. I hope everybody is on and can hear me okay. Welcome to the 2011 forecast call. My name is Jason Hartman, and I know a lot of you are probably followers of our podcast and our radio shows and so forth, so you're familiar with our content and probably recognize the voice. Anyway, welcome. Happy New Year to you. I think 2011 is going to be, for some, for the people in the know, the people on this call especially, really going to be a pretty fantastic year. I'm much more optimistic than I've been in the past, say 2 years, because I think we are reaching some real important pivot points in the real estate market, in the income property market, and I think they're going to make a big, big difference this year. So first of all, I'd like to just unmute one of our guest speakers tonight, and that is Doug, who you've heard him on the podcast before, and he has spoken at some of our Meet the Masters events. Doug, you should be unmuted. Are you there?
I most certainly am there, Jason.
Okay, and if you can just, when you're speaking, just speak up a little bit. You're a little bit faint. So tonight we're going to take approximately 1 hour, and let me just kind of give you an overview of what we're going to discuss in this call. First of all, we're going to discuss what makes our forecast so unique. This is really the most, and I can say this without hesitation and without hype too, we have the most unique forecasting in the entire industry. I have never seen anybody that does it the way we do. And why I say that is because income property is a multidimensional asset class. And while there are many predictors and prognosticators who go out and say this market, that city are going to appreciate or depreciate by X percentage, that's all well and good. But they're missing a much more fundamental, much more important part of the picture, because real estate, or income property especially, not just real estate, but income property specifically, is not to be judged only by its appreciation or depreciation. It should be judged by its multidimensional nature. And at the very least, it should be judged by appreciation, depreciation, cash flow, and leverage. Now, tax benefits are also very important, but they're too complex for us to address in the forecast book. So we left out tax benefits, but just know this as we start to talk about different markets tonight and sort of fundamentals in the economy as a whole. Understand that tax benefits only make everything we discuss tonight better for you, the investor. So whatever numbers we discuss, tax benefits actually improve them. And the tax situation is kind of complicated because not everybody directly or immediately qualifies for the tax benefits offered by income property. So again, we're leaving out tax consequences, just discussing the three factors: appreciation or depreciation as number one, leverage or the use of borrowed money as number two, and cash flow, the income the property generates, as number three. So we're covering those three segments of the multidimensional nature of income property in the forecast book. Now, the book includes 30 different markets nationwide. There are 20 markets that you hear about all the time in the news media. What are those markets? Well, they are the markets surveyed by the very well-known Case-Shiller Index, the Case-Shiller Index. And the Case-Shiller Index is rather interesting, but it can be rather misleading for a prudent and smart investor. Why is that? Well, last year when we did the forecast, and we do this every year, last year when we did the forecast for 2010, of the 16 markets that Case-Shiller profiled, we only liked 4 of them. Only 4 out of 20. I'm sorry, I said 16. Of the 20 markets Case-Shiller profiled, 16 of them we thought were bad, and 4 were good. So only 4 out of the 20 were acceptable markets for us. This year it actually improved slightly, where we actually like 5 of the 20 Case-Shiller markets. So in our forecast, we include 10 supplemental markets that are not part of the Case-Shiller Index. And these are markets that we think are very, very important to keep your eye on for opportunities as an investor. So that's kind of the forecast book. And in the front of the book, and this is an 82-page book, it's bigger than it's ever been. In the front of the book, we talk about various economic things overall. We talk about inflation, deflation, we talk about the value of a dollar, we talk about various fundamentals, and then we go into the 30 markets that we profile. Tonight on the call, we plan to profile 4 of the 30 markets. And of course, the rest of them you can see in the forecast. Time permitting, we may throw in another 1 or 2 if we can. And so that's it. So before we have our guest speaker talk tonight, I just wanted to talk to you a little bit about Section 1 in the forecast book. And that is entitled, "A Dollar is Not a Dollar." And what's quite interesting here is that we have seen a second big round of what's called quantitative easing. Now, I think this is quite a misnomer. They ought to call it printing fake money, because that's exactly what it is. But of course, quantitative easing, people won't necessarily understand that. If you thought our government spent a lot before, in past years and past decades, it is nothing like it is today. Our debt has reached astronomical proportions, both at the federal level, the state level, and the municipal level. All of those levels, our government debt is way out of sync with our production, otherwise known as our GDP. And you combine this factor with the scarce resources. I don't know how many of you follow a guy named Jim Rogers, but I'm a big fan of Jim Rogers, and he is often in the media because he's written several books, and his last book is called A Bull in China. And he was quoted as saying something I think very, very insightful just about 2 years ago. And someone asked him at a conference where he was speaking, they said, Mr. Rogers, what do you think about peak oil? And he replied, forget about peak oil. It's peak everything. So we have a situation now where consumption is dramatically increasing around the world, and we have a situation where our government and many other governments around the world have huge debt burdens caused largely by legacy costs, by big promises that they've made that they cannot sustain. And the way they will solve this problem will not be pleasant for most people. They will inflate their way out of it. recently, just last Sunday night actually, I got back from a ski trip to Colorado. And when I was in the airport, I was in the Denver airport, had a long layover, and so I went and I picked up went to the magazine store, the newsstand, and I picked up a copy of a magazine that I don't usually read, but it's National Geographic. And I would highly, highly recommend that all of you listening go out and get the January 2011 issue of National Geographic magazine. And on the cover it says population 7 billion, billion with a B, how your world will change. And this year in 2011, we are going to hit the 7 billion mark. And in just 13 short years after that, we will hit the 8 billion mark. In other words, any property that you buy today, you won't even be halfway through that mortgage when the world adds another 8 billion people. Now, I just want to share a couple other headlines, and then we'll get into the forecast and the details of it. But it's interesting because when I travel, I find that I have a lot more time to read. And that's one of the things I actually really like about travel because I'm not distracted. And so I get to read a lot. And just going through 2 issues of the Wall Street Journal, and I've got them laid out on a card table here I set up on my office, I want to share with you a few of the headlines from just 2 issues of the Wall Street Journal. Not many. On the front page of the Journal, for January 14th, last Friday, it says, new hit for cash-strapped states. Borrowing costs up as bonds flop, refinancing crunch nears. So this means the states, which total about 45 states out of 50 in the United States, are strapped for cash and their borrowing costs are about to rise. So you see that article. And then you turn the page, a couple of pages, and you see another article that says, Europe's central bank warns on prices. And right next to that on page 9, you see Seoul, South Korea, sees inflation pressure and lifts rate. So they're raising rates in looking at inflation. And then on page 10 of this same Wall Street Journal World News section, you see 2 articles about tragedy. But I just want you to notice something about tragedy. And of course, tragic events are awful. But these are natural disaster tragedies. One on page 10 says nearly 500 are dead in Brazilian flooding. The other article says Australia's costly cleanup tab keeps rising in the wake of their natural disaster. And then you keep turning the page, and that's it for that section, sorry. And then in the next one, on the marketplace section of January 15th, you see a big article about Africa. And you see that Africa is now the next big sort of star on the world stage. Why is that? Well, Africa is finally coming of age. And on the back page, on page B8, and this is the Wall Street Journal for Thursday the 13th, actually, you see how Africa is starting to really boom. And it says a continent's burgeoning middle class sparks new gold rush by multinationals. Foreign direct investment is increasing in Africa, and it shows how consumption is increasing, production is increasing, and Africa is really finally getting its legs. So that would seem like good news. And it is good news for investors who are paying attention. And then you look at the Wall Street Journal for that same one on the front page section for January 13th, and there you see crop prices soar on supply warnings, talking about food shortages. The next page you see food and oil drive up import prices. And then you see on page 3, Illinois braces for tax increases. And there's a section that says coming up short. It talks about Illinois, California, Michigan, Nevada, and Rhode Island and their big, terrible deficits and how they're going to have to raise taxes and cut services. And what this all totals, and the National Geographic article that says a lot more, is you see dramatically increased consumption around the world. Now, what does that mean to a United States real estate investor? Well, it doesn't mean that there will be a whole bunch more people from Africa coming over to rent your house in Indianapolis or in Phoenix or in Dallas or Los Angeles or wherever it might be. But what it does mean is that these people stepping into the middle class, increasing their consumption, will be increasing their consumption of the raw materials that are the ingredients for the houses you buy here that are not indexed to the dollar only. They are globally traded commodities. And that is so important to understand. And it is also so important to understand that our government, as well as many other governments around the world, are going to inflate their way out of their problems by printing more money and thereby debasing the value of the dollar and basically paying off your mortgage debt for you. So long-term fixed-rate debt, a great strategy we've been advocating for many years. Doug, why don't you talk to us a little bit about the boom, the bust, and the recovery, and the 4 stages of that?
Sounds good, Jason. So
Okay,
what I want to outline here is what I call the 4 stages of bust and recovery. And I'm going to leave the boom out of here because I'm going to assume that the bubble boom has already happened. So the first case is your bust. And this is basically where the bubble pops and then values immediately start adjusting. And this is what happened in Q4 of 2008 and 2009 financial crisis with all of the foreclosures that ended up happening and just the free fall that the market went through. So that's stage 1, your bust. Stage 2 is your decline. And for the sake of our forecast call, I'm really focusing this on real estate markets. So stage 2 is the decline. And what happens from the decline is that after the financial crisis, now we have really tight lending standards. I'm sure a lot of people will remember that back in the days when if you could fog a mirror, you could get a loan. Well, now you need to be the most perfect lily white of all possible borrowers in order to be able to get financing. So what that's done is that's decreased home ownership. Is because since it's harder to get a loan, it's harder to buy a home, there's not as many people buying homes, but rents aren't really inflating. And so I think there's a lot of people who are saying, well, if the homeownership rate's going down, then why is it that rents aren't going up? And the numbers show that the homeownership rate's going down. I believe the homeownership rate topped out at about 69% in 2004, and it's down to close to 67% right now. And I think from the early 80s through the mid-90s, it was at about 64%. I'm going to get to that in the recovery, in the trough and recovery stage. But anyway, the homeownership rate is edging down, but rents aren't really inflating yet. And the reason for that is because a lot of people are either doubling up or moving in with their parents or making small shifts at the margin to where they're not moving straight out of a house into a rental. There's a lot of people that are making small shifts to try to absorb some of the slack. That's in the decline stage, and that's where we are today. Stage 3 is the trough. This is really the thing that precipitates the market bottoming out. And the thing that is going to trigger the trough is going to be when all this quantitative easing spikes interest rates. Sooner or later, what is going to happen is that all of this extra money is going to push up interest rates. And when that happens, the effect that it's going to create is that mortgage rates are going to go through the roof. And so then that is going to decrease affordability even more. But the effect that's going to be created by that is that the people who are income property investors now will not be able to make money on deals that they buy with credit. They will only be able to make money on deals if they buy with cash because the interest rates are going to be so high. And this is what is going to drive down homeownership rates. I personally think that the homeownership rates are going to bottom out around where they were in the 80s and early 90s at about 64%. But what's going to happen is it's also going to continue to drive down prices, but it is going to skyrocket rents. Here's a small illustration that I put together from some Census Bureau data. So based on the estimated growth in the total number of households at a historic rate of right around 1%, which is pretty reasonable, if you assume that the rate of homeownership is going to go from about 67% today down to about 64% in 2016, which also is not an unreasonable assumption, that means that from now until between now and 2016, there are going to be approximately 5 million new renters in the marketplace, and the total number of homeowners is going to be almost exactly the same. So that means new homeowners will be coming in, people will be losing their houses going out, and the net increase is going to almost all be renters. And so right now is that window of opportunity to get into income property ownership while rates are still low before they skyrocket, and then the market only really becomes accessible to cash investors.
And two things just to mention on what you said, Doug, that I want to point out. You mentioned a few minutes ago that the cost of home ownership will go up because of this rate increase that's coming, and that's the reason that's coming is it'll have to come to stave off inflation when that starts to hit and look ugly, and also because our spending is so irresponsible and our trade imbalances are so large, especially with China, is that we have to pay a very high yield to get other investors to buy our bonds, right?
Sooner or later, we're going to run out of people who are willing to pay 2%, or willing to accept 2% rates of interest to loan us money.
I mean, think about it. Anybody on this call, would you accept a 2% interest rate from a borrower who was so massively in debt, who owed more money and has no intention to stop spending like a drunken sailor? I mean, what Ronald Reagan said years ago is and this is when the government spent a lot less, is he said to say that the government spends like a drunken sailor would be unfair to drunken sailors, you know? And would you loan your money to a borrower that was as irresponsible as the government, that owed more than its own GDP and kept borrowing and kept spending? I mean, 2% is not enough for that kind of subprime borrower. You need to get a lot more, a much higher rate from that subprime borrower, right?
Absolutely, yeah. And I think the 2%'s around the 3 or 5 year notes. The 10 years are still under 4%, so still ridiculously low relative to the inflation risk for the U.S.
Absolutely.
And so now, moving on to the fourth stage, this is the stage that we'd all like to see come, and that's the recovery stage. But the recovery stage can only happen after the market has adjusted back to equilibrium. So the whole problem that we have with a bubble boom bust cycle is that when you have these big bubbles, everything gets out of whack. The prices escalate because there's irresponsible lending, there's money printing for social programs, and. You have a long list of things that all push the fundamentals out of alignment. Before we get real growth, not just pretend growth from the Bureau of Labor Statistics monkeying with the CPI so they don't have to deflate GDP or something like that. But if we're going to have real growth in production, then that means that everything is going to have to get back to equilibrium. And when everything does get back to equilibrium, then what will happen is then you'll have some real productivity gains that will start to absorb some of the idle labor. Then eventually what will happen is you will start to see people who can actually afford to move out of a rental and into a house. Now, I don't have the slightest idea when this is going to be. My best guess would be that it is multiple years away, probably close to 5, maybe more. I may be wrong. It may be coming a little sooner, but I think that most people have drastically underestimated how much of an adjustment is going to be made for a real fundamental recovery. And the real opportunity that we have is that right now we are at a space where interest rates have not yet spiked. As an income property investor, you can still be a credit-based income property investor and, frankly, get very good deals. But once interest rates go up, then the credit-based investors are all going to be pushed out of the market because, so for example, if you have a deal that makes really great sense at a 5.5% interest rate, what's going to happen when the interest rate goes to 12%? You're not going to have anybody who invests credit-based because the numbers don't add up, because they'd have to absorb a loss every month. And so once the interest rates spike, then the people who are going to be investing will shift from being credit-based investors to cash-based investors. But consider that if you buy now, then what will happen is you will lock in your cost of borrowing at the current low rates, but then you still get the benefit of all that rent inflation. When the lower homeownership rates push those extra 5 million people into the renter pool, all of that rent inflation, you're going to get the benefit of all of that, and you can lock it in at an interest rate that in many places is still below 6%.
And just to be clear on what Doug is saying, is that there's an optimal time to be a cash buyer and an optimal time to be a credit buyer, in other words, using a mortgage to buy the property, which we totally recommend. We think having the mortgage is a huge asset, and it makes the investment perform a heck of a lot better. So the optimal time to be a credit buyer with a mortgage is right now. Absolutely right now. Now, of course, it depends where geographically. And, of course, you need to buy with a fixed-rate mortgage, not an adjustable-rate mortgage. And the optimal time to be a cash buyer is actually a little bit in the future. Right, Doug?
Yes. The reason for that is because when more people get pushed out of the homeownership pool, that's going to inflate rents. And so as a cash buyer, you will recognize a higher rate of cash flow, probably at a short period in the future after interest rates spike.
Right. However, if you are a cash buyer today, you're not going to do poorly as long as You buy in a market with very, very low land values, and you buy at or hopefully far below the cost of actual construction or replacement. For example, in most markets, it would cost anywhere between $80 per square foot, and the really expensive markets that are overregulated and you have big intrusive government might cost $140 per square foot to build a house. And of course, this depends on construction quality and so forth. And that's generally the cost. Well, in some of our markets, you can buy properties now for as low as $30, $35 a square foot pretty reliably. So even if you buy with cash now, you're doing pretty good, because we do see values declining more in the markets with high land values. We see definitely a decline ahead for that. But we don't see a decline ahead for the markets with very low or basically free land markets, where you're buying below cost of construction and the land is actually free. Anything more to say on that, Doug?
The only thing that I'd really add is that there have been some rumors floating around that as the government slowly comes to realize that it's broke, that it may stop funding Fannie and Freddie. And
right.
If that happens, then that will precipitate the spike in interest rates, because the 30-year mortgage will disappear.
Yeah, and so that's actually our next topic. And hopefully most of you have heard the Creating Wealth podcast, my show, episode number 200. That's the one with P. Harvecker, the motivational speaker, author of Secret of the Millionaire Mind. And in the beginning of that show, in my monologue portion, I talked all about the possibility of Fannie Mae and Freddie Mac, the two big secondary mortgage markets that make the U.S. totally unique and differentiated from virtually any other country on earth in the way mortgage financing is done. You see, the big thing in the United States is that housing has really been subsidized by the federal government since the Great Depression. And that's why the opportunities are so interesting here, because really nowhere else can you consistently and reliably get long-term fixed-rate mortgages. And the reason is that they don't securitize the mortgages the way we do, where a bank makes the loan, pools it, sells it off on Wall Street, and then people buy the securities attached to those mortgages. So they typically slough off the low interest rate of this mortgage to older investors that buy what they thought were conservative bond funds, right, Doug? Oh, is Doug still with us?
Yes, that's correct.
Okay.
Sorry, I was just on mute so you wouldn't hear me breathing.
Oh, okay. Well, don't breathe too heavy. But what Congress is going to face this year, and now keep in mind, after November, we had a big sea change in the politics of the country where the voters basically said, look, we're really fearful of the government debt piling up. We're really fearful of all of this spending. And regardless of your political party, and those of you who listen to the show probably know where I stand, but people are scared of this. And if they're not on the dole, as 47% of the country is, in some way getting government aid, if they're not on the dole, they are really scared about spending. They're really scared about the value of their savings and their income as they go into the future. So it's going to be somewhat unlikely, and I can't say totally unlikely, that the Republicans now are going to vote for much. They will probably vote for some, but Republicans today are like Democrats of yesteryear, and they're spenders too. So it's unlikely that you're going to see any big massive support for more bailouts and more money going to Fannie Mae and Freddie Mac. So what does that mean to you? Now, the common wisdom, the common thinking on this is that if Fannie and Freddie go under, that will just kill the real estate market. It will be just a complete disaster for real estate. And I agree, ... sort of. I sort of agree. Here's the distinction that I think most people fail to make. Number one is, I think it will really, really devastate high value or land value type markets like California, New York, Massachusetts, any expensive market, Chicagoland area, any expensive area will be absolutely, utterly devastated by a potential failure of Fannie Mae and Freddie Mac. But the markets where the asset isn't very credit-based, where people can buy with low, reasonable mortgages, or they can even buy with cash. And two markets come to mind that we cover and do a lot of business in, Phoenix and Indianapolis, for this type of thinking. And we have others too, but those are two that instantly come to mind, where the values are so low and prices are so reasonable. We actually think the failure of Fannie Mae and Freddie Mac will ultimately be good because it will make America start to look a lot more like Europe. Now, I don't think that's good. When I say look like Europe, I've been to Europe many times. I was born in Germany, and Europe is a great place to visit. Of course, it's beautiful, cultural, very interesting. But the problem with Europe is that the standard of living compared to the United States materially absolutely stinks in Europe. It's terrible. Most people rent like they do in New York City. Most people rent because housing is just out of reach for most people. And when they do own or rent, they live in such moderate properties that are just not nearly as nice as the way the typical American gets to live. So what will happen is we will become a more of a renter-based society, and as Doug alluded to, rents will just skyrocket. If you can't get these long-term, low-rate mortgages because there's a Fannie Mae and Freddie Mac, because real estate has been subsidized in America since the Great Depression, then you are going to see rents absolutely skyrocket. Remember, there is always an equalizing factor, there is always a counterbalance, and there is always an opportunity in every problem. So, as Doug pointed out in the chart that he was verbalizing to you, this is really the trigger for stage 3. It's a bust in some markets. It's a boom to people who already own property as investment because they will have a lot of upward pressure on rents, which is wonderful for them. But the big window of opportunity is in stage 2, that decline when prices are depressed and interest rates are still low before the rates have spiked. So it is absolutely urgent that you take action, because when an investor wants to invest into the next stage, think about the decision they have to make. They're looking at interest rates that are maybe 3% higher than they are today, which still aren't even high. Note that when I got into the real estate business, interest rates were 14%, and everybody thought that was a bargain because they were coming off 19% under the Carter era. So when rates go up by another 3% or so, which is not 3%, by the way, that's more than 30% relative to where they are today. That's very important to understand. An investor, if he wants to buy an income property, probably won't invest because the rents have not yet spiked and the cost of ownership is very, very high. So what does that mean? It means a lower supply of rental property, and that means upward pressure on rents. Same decision is true of a homeowner. If a homeowner wants to go and buy a home, they think, well, gee, it's just too expensive. I can't afford it. Even though the prices are good, the rates are so high. And remember this, everybody, 1% in the interest rate equals about 10% in the value of the property. That's what it typically equates to. So if you see interest rates spike by 3%, which is really more than 30% compared to what they are today, well, that's about 50%, right? 6% now, for example, 3% spike, and I'm talking about investor rates, not homeowner rates, by the way. That's a 50% increase in the interest rate. So that 3% in the nominal number, going from 6 to 9, for example, that is got to be a 30% price reduction or 30% increase in effective cost of owning that house. So do you see how incredibly significant a swing like that is? Even when interest rates go up just 1%, it's a huge, huge difference. So let's talk about our first market here. Doug, do you want to talk about Indianapolis a little bit? I figured that's a good market since you own property there, and this will be our first part of the prediction. I just bought a property in Indianapolis recently, and that's a market we've done a lot of business in for our investors.
Let me take a brief pause. We'll be back in just a minute.
Want to know what you've missed in the Creating Wealth series? Well, here's your opportunity with Jason's 5-book set. That's shows 1 through 100 through digital download. You save $288 by getting this 5-book set. Learn all of the advanced strategies for wealth creation. For more details, go to jasonhartman.com.
one of the things that really distinguishes Indianapolis is that their tax and regulations are both very light, in addition to the fact that their land is very inexpensive relative to a lot of other major metropolitan areas. And so I think the thing that really turns that into an excellent rental market is that, when you have low taxes, when you have cheap land, when you have light regulations, then you tend to attract more business that has blue-collar employees. And the reason why I tend to emphasize blue-collar employees is because blue-collar employees are the people that are more likely to rent versus own. And when you have the lower tax markets, then what can happen is businesses that make lower profit margins, which tend to have more blue-collar employees, they can still make a profit in markets like Indianapolis or Kansas City or Phoenix. Whereas if you're in a place like Los Angeles or San Francisco or New York, you need to make a lot of money in order to clear all of the costs of tax and regulation. So then what happens is you generally cannot tend to employ as many, tend to have have industry that's more labor intensive that employs more blue collar people. Anyway, one of the things that's unique about Indianapolis, and I actually found this out from talking with the realtor and with some of the property managers, is that during the bubble, there were a number of builders that were getting people into houses, but what they did was they lowballed people on the payments by setting their escrow accrual at the builder tax rate. For those of you that own homes, I'm sure most of you know that that whenever you do a monthly payment, you have principal, interest, tax, and insurance. And what happens is your estimated tax burden is broken into 12 pieces, and then that's added onto your to your monthly payment. Well, typically, when the builder pays taxes, they pay almost no tax, especially in Indianapolis, because the land is really cheap. Well, what happens is as soon as you build a house on it, then all of a sudden the land becomes more valuable. As soon as that property gets reassessed, then you have a whole bunch of people who now just saw their mortgage payment go up. And then when their mortgage payment went up, all of a sudden they went from being able to afford the house to not being able to afford the house. So what happened was there's this big inventory of foreclosures, but there's still a lot of people in Indianapolis that have viable employment. It's just that now their credit's shot and they can't afford to buy a house with conventional financing. So there is a big pool of, frankly, very high-quality renters in Indianapolis that used to be owners. And so I think the combination of the favorable tax and regulatory environment, the plentiful supply of blue-collar jobs, and the large amount of renters that used to be buyers who, frankly, become very good renters makes Indianapolis the kind of place that we very highly recommend. Now I'm going to let Jason take over with one of his favorite markets in the whole face of the world, Los Angeles.
You're joking. Of course, he's being sarcastic. But just one thing I wanted to say to dovetail on what Doug mentioned, and we've talked about this before many times, but one of the great things about a market like Indianapolis or any market with large blue-collar employees segment is this. They're not very impacted by what Joseph Schumpeter called years ago creative destruction, because those are sort of like smokestack industries. These are industries that have huge infrastructure costs. They don't move easily. It takes years for them to change. They change very slowly. They're not like the Bay Area in California, San Francisco Bay Area, Silicon Valley area, where some new idea can just change everything overnight. I mean, where you could have the next Google, the next Facebook, the next Apple product, and everything changes. And that causes more job instability. So that's one of the important things to know about. Now, Indianapolis is a market that we think is a good place to invest. Los Angeles, on the other hand, that I'm going to talk about now, we think is a lousy place to invest. But before I do that, Doug, I just wanted you to quote the returns for Indianapolis, if you have the chart in front of you, and just break it down to the three components, if you would.
Certainly. So in Indianapolis, there's two components to the returns for Indianapolis. Well, actually three components to the returns. The first component is the appreciation. The second component is what we've built in as a regression to replacement cost. And so basically what we've done for each of the markets in this, for each of the markets in this summary is that we've built in the regular appreciation, but then we've also built in regression to what we call regression to replacement cost, which is that in some markets such as Indianapolis, prices right now are below the cost of new construction. So what that means is that there is a certain amount of built-in appreciation that just gets you back to the cost of what it would cost to build the property again. Now, we're not assuming that all this is going to come in all at once, but what's going to happen is there are going to be some of the properties that will naturally appreciate, and some of the other properties, that, especially the ones we recommend, that will have some regression to replacement cost built in. And so the combination of those two items, of both the natural appreciation and the regression to replacement cost for Indianapolis, comes to about 3.7% is what we're estimating for 2011. But when you multiply that by leverage from a conventional loan, because the way we have all these built is for credit-based buyers who can use leverage to amplify their returns, that adds another 11.8% to the return on investment. Now, that is just the leveraged appreciation, and that adds to just about 15%, or about 14.5%. But then when you add on the cash flow, which is very high, especially if you get in some of these deals that Jason has that are very, very inexpensive, the cash flow adds, we're estimating to be another 16.5%. And the reason for that is because the market rents in Indianapolis, the market rents in a place like Indy are not significantly lower than a lot of other markets that have much higher land values, and especially if you can buy in at these really low prices, what that does is that makes your cash generation exceptional. So when you add everything together, our total blended ROI estimate for Indianapolis in 2011 is 32%. That is far and away one of the better markets because of the spectacular cash flow.
So 32% is our projection, and again, we want to say that this is just a projection, but because we're looking at the multidimensional nature of an income property investment, we are projecting a 32% gross ROI for Indianapolis this year in the midst of a huge economic crisis. Now, thank you, Doug, for that. Let's go to an area where we look at not so hot return, and that's Los Angeles. And I grew up in West Los Angeles, so I'm very familiar with the area. My mother was buying many rental properties around there when I was a kid, and we are projecting a negative return on investment in Los Angeles, negative 17.5%. Why is that? Well, high taxes, intrusive government, stringent business regulations have pushed out all the low-margin businesses, have put a huge pressure on any type of manufacturing business, and they've largely pushed them out too. The remaining businesses must produce super high profit margins to survive and endure all the regulations. And the high-margin businesses tend to be more volatile because these are more white-collar type businesses. We just talked about that as we were talking about Indianapolis. Many of the high-profit businesses in L.A. have been destroyed by the financial collapse, and the fundamentals just do not support good growth. Now, one disclaimer I have to make about Los Angeles, and I'm also going to profile Phoenix, which is a market we recommend, unlike L.A., is that L.A. is a very, very mixed bag. Of course, it's a huge city, but it's not just a mixed bag in terms of its size and its number of areas and lifestyles and so forth. It's a mixed bag from low to high-end properties. And that's what we call market segmentation or submarkets within a large market. And the disclaimer I have to make is really based on how hard it is to predict things in markets where there's such a mixed bag. I mean, think about it. If you live in Los Angeles, nobody really knows how you live, because you could live in a slum in a war zone, or you could live in Bel Air. And the contrast is just huge when you're talking about Los Angeles. But a couple other things I want to mention about this market is that serious distress, likely to experience continued difficulties before a recovery is in sight. The public pension problem is estimated at about $500 billion. That's $500 billion. That'll require tax increases, benefit cuts, really both of them, and a large number of the people in the greater Los Angeles area are receiving some sort of government benefits, which will impact this economy in a multiplying negative way. Values were temporarily stabilized a little bit when we had the first-time homebuyer tax credit, but once that government subsidy ran out, we exposed the truth again to what the market's really like. So again, with about 60% of the properties in LA being foreclosures, with the rent-to-value ratios being absolutely lousy for investors, it's a landlord-unfriendly market. We're predicting an appreciation rate. And again, note my mixed bag comment earlier, but the appreciation rate is 2.9% predicted, but the cash flow brings it down to a negative 17.5%. Leverage brings it up, 9.1. Overall, bad deal in Los Angeles. I wouldn't touch it. Next market, Doug.
So the next market is Washington, D.C., and there are some similarities in that between D.C. and L.A. in that D.C. is another one of those markets that has very high land costs, very, very stringent regulations, very high taxes. But D.C. has come into focus because since the government has gotten so huge that there have been a whole bunch of jobs that I'm not going to say created, but a whole bunch of jobs that have emerged from the D.C. complex, either from lobbyists or from government contractors or things like that. And so a lot of people have looked at the D.C. area and see the low unemployment rate and think that it might be an attractive place to invest. But there's a couple of factors that make D.C. it makes it a real, I would say, a sucker's bargain or a fool's bargain. And the first thing is that similar to Los Angeles, although not quite as extreme, the values are still very high. I mean, the values are still really very high relative to rents. So our blended ROI profile is 6.1%. But what happens is, you have about 5-ish%, just over 5% base appreciation. And then that leverages out to just over 16%, about 16.6% of leverage. But then you have to scale that back by 15.8% negative cash flow. So from a cash flow perspective, if you buy an income property in D.C., you're going to need to continually subsidize negative cash flows until someday when you hopefully sell it at a profit. And that's where the second danger of D.C. really comes in, which is that sooner or later we're going to have to pay the piper, and that right now the government is unsustainably large. And so somehow, some way, at some point in the future, things will need to get smaller. And when that happens, there's going to be the D.C. is going to go through its own boom bust. Right now it's in a boom because D.C. correlates with government spending. And as Jason said, government spending like drunken sailors in a manner that gives a bad name to drunken sailors. But sooner or later, the hangover is going to end, and when it does, D.C. is going to be in pretty sorry shape. Nobody really knows when that's going to happen, but D.C. is just one of those areas that we really don't like, just because it's going to be too volatile and it doesn't have the fundamentals for a real long-term growth trajectory. And now I'm going to give it back to Jason because I know we told everybody that we'd be done by about 6:30 and want to make sure everybody can go have their dinner.
Yeah, so we're just a few minutes away from wrapping up here, folks, and I do want to say to you, thank you all for hanging on the line. Not a single person has left the call, so that's great. I think we're being somewhat interesting. That's good to hear. But we do have a special offer on the predictions book for you, and it's a pretty darn special offer, so we'll make that in just a moment, and you'll have to have the promo code that we're going to give you in order to take advantage of that offer. If you want to get the full 82-page report, you can also get the audio version of the report as well. So we'll have special offers on both. Let me profile now Phoenix, Arizona. Now, Phoenix has always been what's called a linear market, meaning that values just sort of chug along until the last housing boom. That's the first time in its history that it became what we call a hybrid market, because it became cyclical in that last boom, and it was never that way before in any of its other cycles. Now, with Phoenix, you've got a pretty attractive climate because you've got low taxes relative to the rest of the western U.S., and a location that's friendly to business with many, many blue-collar jobs. The foreclosure rate is pretty high at about 54% of the listings out there. So, again, LA being at 60% foreclosure, the foreclosure rate isn't necessarily bad. It could be good if the other fundamentals line up. But yes, it's very attractive in that sense, and many people who were previously owners are now renters. The Phoenix market has basically contracted in value pretty dramatically, and prices are at approximately the same level they were 10 years ago in 2000. So they've regressed back to that. You can buy properties today that are far below the cost of actual construction or replacement. And I do have to say with Phoenix, it's also like LA, but to a lesser degree, a mixed bag in terms of prices and values. So it's important for you to understand that, because in some areas of Scottsdale and Paradise Valley, you can buy multi-million-dollar beautiful homes. But you can also buy very nice, very inexpensive rental properties there that make a lot of sense. So again, it is a mixed bag in that way. Our overall prediction for Phoenix, Arizona this year in 2011 is an overall ROI estimate that is positive of 19.4%. And the way we come to that is 3.4% appreciation, so just minor appreciation, but it is on the positive side, so that's good news. You amplify that with leverage, that gives you another 10.8%, and then cash flow being so good there, because the rent-to-value ratios are very, very attractive. You can sustain very good rents in comparison to prices of 5.1%. So you're going to make about 20% there, we're predicting, this year in terms of gross ROI in Phoenix. Now, just understand that what we've talked about tonight is a great window of opportunity. The information that we've shared, the information that is in this report profiling 30 different markets. We have profiled 4 of them tonight, but there are 30 in the report. Only 20 you're hearing from the mainstream media in terms of the Case-Shiller Index, but we do something nobody else does. We have taken a very innovative approach to looking at income properties because we are literally the only one that accounts for the multi-dimensional nature of income property. And those 3 elements that are in the report on all 30 markets include appreciation or depreciation, cash flow, and leverage. And that's really the way you have to accurately look at a real estate investment. Now, if you go to jasonhartman.com, you can buy this report for $197. It's 82 pages long. You'll instantly receive the PDF downloaded to your computer. And if you have a Kindle or an iPhone or an iPad or any kind of ebook reader, most of them, you can read it on that reader. So that's a fantastic way to do it. Or you can print it out, of course. And it is an 82-page full-color report. It has beautiful graphics. A lot of the stuff is explained visually, and we can't do that on the call tonight, but it is in the report, and each market has its own what we call ROI build, which is a graph breaking down those 3 elements in color, and it's very nicely done. We're also having an audio version produced now as we speak, and we can't promise exactly when you'll have that, but it should be 2 weeks. I want you to say, give us 3 weeks just in case. And we have our professional narrators doing the audio version. So you can get the audio and the printed copy. We didn't want to sell the audio alone because we really think that you need the visuals. You may want to listen to it on your iPod or in your car or wherever, so it's mobile. I love audio content in that way. But you'll want to refer back and look at some of the graphs in there to enhance your understanding of it because it is, again, very, very unique in terms of what's out there. And that is $297. However, and here you go, here's the special offer, tonight only, how do you like that? You can get 50% off. This won't be offered on our website. You can get both of these for half price. So that means that the printed version is less than $100 and the audio version is less than $150. And here's the special promo code. It's CALL, C-A-L-L, not capitalized. Just type in CALL in the box when you check out at jasonhartman.com. Click on store when you go there and use the word call. And until midnight tonight, you will get that special pricing of 50% off either report, either the printed version or the audio and the print version. You'll have both in that way. Thank you so much for joining us tonight. We really appreciate it. I think, and it sounds salesy, but I think this really is the time, especially if you're a credit-based buyer of income property. It's very, 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 very unlikely to be better than this year at any time in the future that we can see in the foreseeable future. So take advantage of it. J. Paul Getty said, buy when everybody's selling, sell when everybody's buying. Warren Buffett says, be greedy when everyone is fearful, be fearful when everyone is greedy. And guess what? Everybody's selling right now, so Getty would be saying buy, and everybody is fearful right now, so Warren Buffett would be saying now's the time to be greedy. Put yourself in position to win. Put yourself in the position where time is on your side. Put yourself in the position where government spending and irresponsible government no longer makes you mad, but it actually makes you happy because now you know how to profit from it. And again, go to jasonhartman.com, promo code is CALL, and take advantage and get the report. And thank you so much for joining us tonight. Happy investing. And also be sure to listen to our free podcast, The Creating Wealth Show. You can get that on iTunes or at the website, jasonhartman.com. Thank you so much, everybody. Happy New Year and happy investing.
Now you can get Jason's Creating Wealth in Today's Economy home study course. All the knowledge and education revealed in a 9-hour day of the Creating Wealth Bootcamp, created in a home study course for you to dive into at your convenience. For more details, go to jasonhartman.com. This show is produced by the Hartman Media Company, all rights reserved. For distribution or publication rights and media interviews, please visit www.hartmanmedia.com or email media@hartmanmedia.com. Nothing on this show should be considered specific personal or professional advice. Please consult an appropriate tax, legal, real estate, or business professional for individualized advice. Opinions of guests are their own, and the host is acting on behalf of Platinum Properties Investor Network, Inc. exclusively.